Hey everyone, after almost 2 years of subdued performance, Indian stock market has again touched a lifetime high, and Nifty, after touching lows of 15,200 has hit a new high and trading at levels of above 19,500. In fact, the mid-cap and small-cap index have jumped even higher. Now at this point, investors are divided into two opinions. On one side, you have investors who are super bullish on stock market and expecting a big bull rally ahead and Nifty crossing levels of 21,000 within a year. On another side, there are a set of investors who are bearish on the market and expect Nifty to correct to levels of 15,000. Now I am sure the sharp rally in stock market in last 2-3 months has surprised a lot of you, and many of you would have missed the investment opportunity in this rally. But if this is a beginning of bull run, then you don't want to miss further opportunity. At the same time, many of you would be looking for a good correction to get better entry points. So in this video, I want to share my thought process of current state of Indian stock market and help you understand whether it is beginning of next bull run or there is a deep correction ahead. Alright, let's get started. So when it comes to stock market, the most important parameter you need to track is interest rate cycle in the economy. If you study the historical bull and bear markets, you will notice that majority of bull and bear market in the past were linked to one biggest single factor, that is interest rates. And if you understand this correlation between interest rates and stock market, you can easily figure out whether we are in bull run or bear market. For instance, during COVID, we saw a huge bull rally when Nifty zoomed from lows of 7,000 to levels of 18,500. This was the time when economy was in a bad shape. Businesses were shut down due to lockdowns and earnings of majority of companies declined sharply. Yet, the stock market zoomed exponentially and we saw one of the biggest bull rally in Indian market. The simple reason was fall in interest rates. So what happens is, when the interest rates are on decline trend, the cost of borrowing decreases. And when cost of borrowing decreases, the liquidity in the market increases. Basically, there is easy availability of money due to lower interest rate. And that money flows into the stock market. And that is exactly what happened during COVID bull run. The interest rates in India fell down from 5.25% during pre-COVID to 4% level. In fact, in US, the interest rates went down from 2% level to near 0%. Just imagine getting money at near 0%. This was basically done to support the economy during lockdowns when businesses were struggling to make money. As a result of near 0% interest rate, a huge chunk of US money got invested into Indian economy via FII mode. To be precise, between May 20 to March 21 COVID period, a total of 2.06 lakh crore got invested by FIIs in India. And that was one major trigger for bull rally in India. I hope it makes sense. Now, lower interest rate has its own disadvantages. It eventually results in higher inflation as everything becomes costly due to high liquidity of money in the economy. So due to lower interest rates, the inflation in India jumped from near 4% to levels of near 8%. And in the US, the situation was even worse. Inflation jumped from pre-COVID levels of below 2% to touch a high of 9%. To control the inflation, government had to increase the interest rate. In US, government increased the interest rates from near 0% to more than 5%. And that resulted in huge liquidity crunch in the market. Money became expensive and hence FI started out pulling money from Indian market. Just to give you an idea, after investing 2.06 lakh crore during May 20 to March 21 period, FIs pulled out investment worth 4.74 lakh crore between April 21 to February 23. That was crazy selling. As a result, we saw a bear market in India in 2022 when Nifty fell down to levels of 15,200. But thanks to strong domestic investment from retail investor, the Indian market did not correct it heavily. So this analysis clearly suggests that stock market and interest rate movement is inversely proportional. If interest rate increases, stock market fall, and if interest rate decreases, stock market rises. Now it's important to understand where we are today in this interest rate cycle. So after a continuous increase in interest rate for more than a year, inflation is getting under control. In India, the situation was not that bad, but in US the situation was really bad. Now, as per latest update, inflation in India is in a much better shape at near 4% level, which is what RBI expect. And in US, CPI inflation has fallen to levels of 3% in latest June data. It basically means we are near the end of interest rate increase cycle. In fact, US Fed Chief Mr. Powell has also clarified that there can be another 25 to 50 basis point rate hike, and then by 2024, the interest rates are expected to go down. And when interest rates will fall, there will again be easy excess of money and liquidity will increase. And remember that FIs have pulled out investment worth 4.74 lakh crore rupees. So that money eventually has to come to India. In fact, in last 4 months, FIs have started investing again in Indian economy with investment worth 62,000 crore coming back into the economy. So it looks like it's just the beginning of FI's inflow in India, which is a very positive sign. Based on the interest rate cycle, it looks like it is just the beginning of another bull run in India. But hold on, what about valuation? If the earnings would not grow and money keeps flowing into the stock market, then it would become a bubble, isn't it? So where does the Indian economy stand in terms of valuation and earnings? Let's have a look. To understand the valuation of Indian stock market, the most common parameter is PE ratio. So if you look at the chart on the screen, it shows Nifty movement in red line and Nifty PE movement in blue line between 99 to 23. So the last 24 years, Nifty has zoomed from levels of 1600 to 6000, then 9000, then 12,000, all the way to currently at 19,500. During this period, if you observe, Nifty PE ratio, it touched a peak of 28 during 2000 dot-com bubble, then fell down to lows of 10, then again zoomed to levels of 28 during 2008 housing bubble, then fell down to levels of 10, when Nifty crashed from 6,200 to 2,500. Now before COVID, when Nifty was at levels of 12,000, PE ratio was at levels of 29, and during COVID crash, PE fell down to 17. That was an amazing buying opportunity. And then during COVID bull run, Nifty PE touched a peak of 42. One of the reasons is because of sharp fall in earnings due to lockdown. Fast forward today, when Nifty is at an all-time high, PE ratio is at levels of 23.8. That's neither too high nor too low. In fact, in last 24 years, the median PE has been around 20. So currently, Nifty valuation is not too far from Nifty 24 years of median valuation. And now that we are in Q1 of FY24 result season, Nifty is expected to post 12 to 14% earning growth, which means Nifty PE is trading at 1 year forward PE of 20, which is neither too high nor too low. Clearly, the Nifty valuation chart suggests that although markets are at an all-time high, the valuations are certainly not very expensive. So this is certainly not a bubble that we should worry about. Again, a positive factor. Now going forward, if you look at Indian economy, there are multiple positive factors that would drive the growth of Indian economy. For instance, the crude oil that touched a crazy levels of $120 a barrel during 2022 has now fallen to levels of $76 a barrel. And when crude oil price fall, the raw material becomes cheaper. Transport cost decreases and eventually manufacturing companies post margin expansion and hence better earnings. Then as far as consumption demand is concerned, it is looking decent in India. On capex front, many companies have announced capex and Indian banking system is already in one of the best phase of growth with lowest NPA and a new credit growth cycle. So all these factors are looking very promising from earnings point of view in coming quarters. And when earnings will grow, more money will flow into the economy. So overall, if we conclude the positive factors that can drive the bull rally ahead, it includes your first, ease of inflation that would result in margin expansion. Second, we are at peak of interest rate cycle that would fall in near future. Third, reasonable valuation as Indian markets are neither too expensive nor too cheap. Fourth, FIs have restarted investment in India after huge selling in last 2 years. And fifth, good consumption demand and new credit growth cycle. All these factors suggest that we are in the beginning of new bull run. Having said this, there are a few negative triggers that can spook out the market in near term. So first is US inflation is still not below the 2% level. Although Indian economy is looking in much better shape, US economy has not really completely recovered from inflation problem. US Fed has clearly hinted towards another 1 to 2 rate hike of 25 to 50 basis point. Although it has already been factored by the market, US Fed has also highlighted that the worst impact of this crazy interest rate hike is yet to be seen in the economy. So it's important to keep a close eye on US economy as a lot would depend upon FI money flow. Any negative trigger on FI flow can impact the Indian market negatively. And of course, Indian IT and pharma sector that contribute significantly in the index generate majority of money from US economy. So if US economy would slow down, it would impact the earning growth of IT and pharma sector and would impact the overall Nifty earning growth. Then second problem is geopolitical tension due to war between Russia and Ukraine. Any negative news on that front can result in correction. Third factor is there's already a sharp rally in the market, especially in mid cap and small cap stock. So going forward, I neither see any major correction in Nifty level, nor do I see a sharp rally at index in the near term. I don't think Nifty will touch levels of 15,000. Yes, there can be some correction here and there, but 15,000 is extremely low probability. At the same time, Nifty will take time to touch levels of 21,000. It won't happen immediately. I believe that now, since we are in Q1 result season, a lot would depend upon individual sector and stock level performance. A good quarterly result can take the stock further up, and a bad result or even a neutral result can lead to profit booking if the stock has already jumped significantly. If we break the market in domestic versus export sector, the domestic sector has seen amazing rally. Be it banking and financial sector, infrastructure like cables and wires, then FMCG, defense, auto, hotel, hospital, capital goods, all of them have rallied a lot. And I expect domestic sector companies to continue to do well. But the export sector has been stagnant for a long time. It includes your IT, pharma, chemical, textile, and so on. These sectors outperformed during 2020-21 bull run, but have struggled in last couple of years. Having said this, it can be a great opportunity to accumulate some of the stocks from export sector. Okay, I don't want to stress this video further. Now that we are in result season, I'll keep a close eye on the market. I already have curated a top list of my stocks from each sector, and I track them closely and discuss the quarter result in my weekly series, where I also discuss my investment strategy and my portfolio detail. It helps in identifying the accumulation opportunity in great companies. In addition, I'll continue to post videos on YouTube and cover great businesses that are looking promising. I hope you'll find this analysis useful. If yes, do share it with your friends. And in case you haven't subscribed to the channel, do consider subscribing and click on that bell icon to get the latest update on my videos. I'll see you next video. Till then, take care.